Hello and welcome to Pricing College with your hosts Aidan Campbell
and Joanna Wells.
In today's episode, we want to cover something that has been in many news articles in one way or another, and that is, I suppose, the return of inflation, which was a monster we associate with maybe times like the 1970s and the 1980s. But inflation appears to be back. A lot of the financial press is talking about it. And from a pricing perspective, it's leading obviously to cost or price increases for nearly all products. And in the pricing community, I'm sure some quite tough conversations with customers.
Yeah, I know from our B2B consulting work, a number of clients are dealing with the impacts of inflation in terms of pricing. But you may have even observed this in your day-to-day life in terms of food price hikes over the last few months. Really, it's not just food, it's clothing, it's B2B, it's everything. It's across the board now. And it's a quite significant problem for both businesses and consumers. I suppose, to keep it simple, inflation basically means that the price of goods and services is going up. And when that happens, there's a tendency that people and businesses lose their purchase power. Which basically means that you're not getting as much for your money. So in turn, a lot of businesses are in a way panicking with this and finding that they have to implement quite quick, sharp price increases to align with this new inflation, but not really knowing if their price increase is correct or whether that they're applying their price increase in the right part of their product portfolio.
Yeah, I think we've been through a historical period, probably from the late 80s to the early 90s, where in Western countries, we've become used to an inflation rate of a negligible rate, really, of like 1%, 2%, that sort of thing. I think recent studies I saw was forecasting maybe next year up to 5% in the US. And, the old saying, if the US catches a cold, the rest of the world gets the sniffles, which probably isn't appropriate in the age of COVID, etc. But, we're now in a position where if you're a B2B business, let's look, or any business really who's selling to customers, but in B2B it's more appropriate, where you have input costs, it could be petrol, it could be timber, it could be sugarcane, it could be anything really. If your input cost and then you're selling to a customer, you could be caught in the middle. At the end of the day, if your cost base is rising, at Taylor Wells we often talk about value-based pricing as a way to avoid cost-plus pricing, obviously. But in this scenario, value-based pricing, you have to, fundamentally, you will have to increase your prices, your selling prices, as the value of money decreases. As your cost base rises, that rising tide, if you don't want to be caught in the middle, if you don't increase your prices to customers, you will face declining margins and obviously threaten your business continuity. The big difficulty is we've been coming through a period where procurement's driving down prices, you're signing multi-year contracts, your price rises are capped at a certain level. It's more and more difficult to push through those price rises. And to be honest, because the fact it hasn't been a big issue over the last 5-10 years, people haven't paid that much attention to it. I've seen contracts where your price rise is capped at X or capped at 1% per annum. But let's be honest, if your cost base is going up by 5% per annum and you're selling, you can only push up a 1% price rise, you're in some trouble.
Yeah, I'm seeing just that with clients at the moment. They used to have very robust price variation formulas in place, and they worked quite well in more stable times. But then recently, in the last few months in particular, even though they're still good price variation formula, they're really not having the impact financially that the businesses need, and they're losing money, quite significant money, which means it isn't necessarily your price rise formula or price rises that's going to help you here. It's getting understanding on three very important things. you've got to understand inflation and the banking monetary system and be prepared for those changes. It can't be something that hits you between the eyes and is a surprise. You've got to understand and have room to move when there's fluctuating costs, because that seems to be with us now, especially with all supply shortages, COVID, etc. It's putting pressure on supply chain. But the third thing, and a really important thing that a lot of businesses forget, is understanding the value of your product portfolio. Often, businesses try to improve margin through price rise or price adjustment strategy without understanding the value of their product portfolio at a SKU level. Generally speaking, product hierarchy, price structures, discount levels are a mess even before the inflation hit. And when inflation hits and you haven't got all of your price architecture in place, that's when you see massive declines. And this is really at the heart of value-based pricing. It isn't just a nice fluffy concept. It's something that really pulls together both your costs, market pricing, customer value, and economic trends, and does it in a scientific and very rigorous manner.
Yeah, like I think touching on that point that Joanna's mentioned, I think do we look back at the last few years before COVID as the good times when we thought inflation was gone forever, etc. I suppose in those times people took their foot off or their eye off what was important. They stopped thinking about it, and there's an entire generation of people who are not used to inflationary pressure. They're not used to what happened in the 80s, the 70s, whereby mortgage rates were 20% and this sort of thing. And people became used to stuff, and when you become used to things and see them not as a risk, you don't look at them. But now this stuff, it exacerbates all the problems. If you don't invest in a value-based function, if you don't understand the value of the product you sell, if you're getting hammered by procurement teams day in, day out, if you're cutting cost, if you're discounting, if you're doing whatever the procurement team, jumping through those hoops that they set for you, you're probably setting yourself up for even more hardship now when there's the other side. You're between a rock and a hard place. You've got the procurement team. If they're used to winning, they're not going to really stop. And if you're used to giving into that, it's going to be a very hard turnaround for you. It's very hard for people to change their personalities or change their negotiating style. And then you have the tide of, the pricing pushing you from the other side. So it's a very tough scenario for sales teams, for pricing teams. But I think in the longer term, I think from an economic perspective, keep in mind that we talk about real pricing and and monetary pricing. So in real pricing, the pricing isn't actually increasing, but you need to push through price rises. If you want a price rise of 2% and inflation's 5%, in real terms, you need to push through a 7% price increase. And to do that, I think you really do need some format of value-based pricing, understanding your value, understanding what you offer, your clients' value drivers, and it's all the work you should have done, in the good times. Now's the time to use it. It's the old Muhammad Ali stuff. You train hard and the fight becomes easy. Have you done the work? Have you done your value discovery? Have you done your training of your sales teams? Now's when it will pay off.
Yeah, I agree with that. And I think for businesses that haven't got a price architecture that brings in all those different elements, will really find and continually find that they'll have to do these ad hoc price rise guesstimates really over the next, until as inflation builds and the margin pressure continues to build. It's just going to be inevitable, which means really that's the majority of businesses, because there's very few businesses that I still see today with a very good price architecture. And I'm still talking leading businesses because those are the people I'm working with. And I'm often quite surprised to see the lack of alignment in the price architecture. Sometimes it's just literally a bare bones price list. That's not a price architecture. But saying that, so what do you do if you don't have that price architecture? Well, you have to have a more considered and planned price rise, and not be shy with price rises, because as Aidan says, increases in inflation require a considerable price increase. So what do? You have to plan it. You've got to consider where you're going to focus in your product portfolio. You cannot do blanket price increases across the board. That'll create much more damage than good. You have to work with sales. Ultimately, highly advise hiring a pricing manager if you don't have one, to coordinate all these efforts and to come up with a very robust price variation formula. But I do stress, but this price rise approach is only a tactical approach. The more strategic thing, the thing that will get you through, is building that product price architecture and ensuring that's in place, and then working with sales, the product team, pricing, to align everybody to this new way of pricing in a very margin pressured industry and time.
I think one final point I'd make, and this is reminiscing back on when I was B2B sales, a lot of contracts would have in there, a CPI adjustment, once a year, capped at CPI, etc. CPI is a basket of goods. CPI is an Australian-based inflation measure, but it's a basket of goods. And anyone who's looked at inflation in the past, certain areas are much more subject to inflation than others, depending on drivers. Is it imported? Petrol prices could be going through the roof, whereas raw materials maybe not going through the roof. So CPI may not really be a defence in some way for you. It may not be appropriate for your contracts. So even just to protect yourselves, a final point I'd make is really understand what you're selling. And if CPI is not appropriate to defend yourself from inflation picking up, these things aren't that important when inflation's 1% across the board. But you could have sectors now where you have inflation of 1%, but other areas where it could be 10%. And if you're capped at a CPI limit of 2%, again, you're just in trouble. So this is really understanding what you're selling, how you're selling, what you're subject to, what your risks are, your continuative supply, those aspects of the insurance concept behind what you're supplying, and have complete confidence that you're not committing yourself to a longer term contract that, without that protection for you. So that's just what I would end on today.
Yeah, I think that's a really good point, and I think it hits the heart of the problem. Businesses don't understand what they're selling. They don't understand the value profile of their product portfolio, so then they do this blanket price increase that often tends to be too high or too low, creating disruption in the market, and ultimately doesn't give them the financial impact ongoing that they wanted. So, I think Aidan summed it up quite nicely before, and I note in the newspapers today that Unilever, Mondelez, Pepsi are not shy with advertising that they've taken considerable price increases in response to inflation. Albeit I'm not sure how well they've increased and exactly where, but I'm sure they've got dedicated pricing teams in their businesses looking at inflation, looking at price rises very carefully, I'm sure.
One final point I'd make, and I just noticed this on the streets recently, this affects businesses of all types and sizes. I've even seen local restaurants, Thai restaurants, who've had a lunch special probably of between $10 and $12 for the last 10 years. I see a lot of them now will even have signs in the windows talking about the cost of materials, of food, of like seafood in particular, seafood, prawns, etc., and saying prices are rising for this reason. So it's even to the smallest local neighbourhood businesses seeing these issues. But okay, we will leave it there today. Have a great day.
Yeah, thanks a lot. Bye.